Japan's imports in the month of October surged by more than a half from a year earlier, as slow growth in exports, which enlarged the trade deficit, weighed heavily on the yuan, recording a trade deficit of 2.09 trillion yuan in the month of September. The world's third largest economy has depended on exports of processed goods such as cars and electronics for growth over the past few decades. But Japan's policymakers are concerned more about the impact of surging imports on its resource-poor economy. The trading gap is said to be worsening the pain felt by households struggling to make ends meet amidst currency-driven price hikes of imported goods and by import-reliant businesses facing difficulties in passing cost rising on the customers. Latest government data showed that Japan's economy had shrunk between July and September for the first time in a year, as import outpaced exports, knocking off substantial portion of gross domestic products. Asian stocks were mixed today, while the US dollar stabilized and treasury yields remained depressed, as investors tried to assess the outlook for Federal Reserve's policy following stronger than expected retail sales data. Japan's Nikkei changed slightly, recovering from early Wall Street-inspired losses, while the broader Topix index was up 0.4%. Hong Kong Hang Seng tumbled 1.35%, with its tech stocks plunging 2.91%. Mainland Chinese shares also declined, with blue chip falling 0.57%. Australian benchmark added 0.19%, while South Korea Kospi dropped 0.58%. MSCI's broadest index of Asian Pacific shares outside of Japan slid down 0.77%. U.S. e-money stock features indicated a 0.3% rebound, following the S&P 500 0.8% overnight retreat. In another report, Indian refiners are said to be cautious of buying Russian crude oil after December 5, when European Union sanctions take effect. Pending clarity on the proposed G7 price cap mechanism, the Asian giants, who are two of the world's top three importers, had become Russia's biggest customer after the West shunned Russian oil after the outbreak of a war in Ukraine. Meanwhile, Chinese refiners have already begun slowing down requests from Russian oil imports. The reduced buying by both countries will leave Russia chasing alternative customers, potentially depressing prices, even if those new buyers are unlikely to join a plan by rich nations in the group of 7 G7 to cap Russian oil prices. Now, oil crude oil slipped today, pressured by easing concerns over geopolitical tensions and Chinese demand worries, although signs of the tighter supply, including lower U.S. inventories, lend support. Now, U.S. West Texas Intermediate crude experiences a downward price margin of 0.92%, selling at $84.80 per barrel. Brent crude features still in the red zone, selling for $92.33 per barrel, with a downward price review of 0.57%. Bonny Light sells for $91.97 per barrel, with a decline of 1.26%. And for the OPEC basket, crude oil dealers offer $91.16 per barrel, with a downward price review of 3.45%.